All right, let's do it. Let's answer some of your questions now. First up, Josh Brown, we have a video question for you.
Hi, my name's Trey from Minnesota. My question is for Josh Brown. A few months ago, you mentioned that you would buy Zillow under $100, and now we are there. Are you looking at taking a position anytime soon? Thanks.
All right. Appreciate the question. What's the answer, Josh?
That's a great question. I remember saying that. I didn't think it would get below 100 in the way in which it did. This stock is now in a 55% drawdown. It's really astonishing how fast it's come down. The only name that looks worse is Opendoor, down 60-something% in the space. It's not cheap, but I do think it's buyable here. However, technically, it looks like a falling knife. So if you really want to be in it, and there's nothing in the chart suggesting that this sell-off is over, I would maybe buy a third and then hold back the other two-thirds for lower prices. If you don't get those lower prices, at least you have some. But if it continues to drop this way, you have some more firepower. Zillow is a $24 billion market cap. They'll do $5.5 billion this year. I do think they have one of the best brands in the entire United States real estate market. And ultimately, the home buying they're doing, plus the mortgage lending that they're now doing, those things will add up to a much bigger part of the business, and the stock will eventually work. I'm not in it yet, but I might at some point soon.
All right, Liz Young, for you from Adam in Ontario, the ETF, the IEMG, has a large component of China stocks. Given uncertainty in China companies, is it time to dump it or ride it out? What do you think?
So, Adam, the reason it has a large percentage of Chinese stocks is because it tracks the MSCI EM index, which has 35% in China. Actually, the top 3 countries in the EM index make up more than 60%. So what I don't want to do is tell you to sell into a downturn that's already about 45 days old. I think there's probably a little bit of a recovery that you can get there. Once you get that recovery, though, find an ETF that spreads out the country weights a little bit more evenly.
All right, Steve Weiss to you from Wayne in New Jersey. I bought Porsche on your advice, not really doing anything currently. Is this a long play for future electric vehicles? Stock's down about 6% in 3 months. What do you tell him now, Weiss?
Look, I love the story. I mean, Porsche, Volkswagen. Porsche owns 53% of Volkswagen voting stock, so it's the same, essentially. But for Volkswagen, which translates to Porsche, as I said, 3% volatility day to day is way too much for a company at 7 times earnings. I love this as a long-term play. I think it's going to continue. I think it will do very well. It's up from where we went into it. I like it. I'd buy more. And as a matter of fact, the arb spread between Porsche and Volkswagen is at a very wide level. Historically, it trades to a 1-to-1 correlation. So if anything, I'd buy more Porsche here.
All right. Lastly, Dr. J, David, Florida. I own some shares of Farfetch. I've been buying dips here and there for about a year and have a good cost on the majority of my position. With the recent pullback, is this a good time to buy more, or should I take some profits?
I would hold, but if you have to be binary, buy or sell, I would buy. This stock is up from $7 at that pandemic low, Scott. It hit $70 this year, and now it's back down to about 38. I think it's a good buy here. Luxury sells, and this one's been building that brand out there. So, yeah, I would buy if it's a binary choice.